Julie Hyman just exited the Fed lockup with the news of Yellen's prepared remarks. What is she going to say, Julie?
Eric, she's going to talk about what's going on internationally. And this is something, of course, she did not mention in her last testimony in February. She says, although the recovery in the euro area appears to have gained a firmer footing, the situation in Greece remains difficult. And China continues to grapple with the challenges posed by high debt, weak property markets, and volatile financial conditions. But here's what's interesting here. She says economic growth abroad could also pick up more quickly than observers generally anticipate, providing additional support for U.S. economic activity. The U.S. economy, she says, also might snap back more quickly. Now, as is typical of Yellen, she, of course, gives both sides here, both the negatives and the positive outlook for the U.S. economy. She says in terms of the labor market, we have indeed, of course, seen improvements. She says, however, there are indications that there is still slack in the labor market. She says too many people are not searching for a job, but would likely do so if the labor market was stronger. And she says, although there are tentative signs that wage growth has picked up, it continues to be relatively subdued. So she's talking about here not maximum employment as of yet. Of course, the Fed's dual mandate has to do with jobs and with inflation. On the inflation front, she says the recent low readings on total PCE inflation, that's the preferred measure of the Fed, reflect influences that are likely to be transitory. She says, indeed, if you look at the example of energy prices, we have seen that the high effect of energy prices has been relatively transitory and energy prices have stabilized. So she says, my colleagues and I continue to expect that as the effects of these transitory factors dissipate, inflation will move gradually back toward our 2% objective over the medium term. Now, in terms of timing of interest rate increases, she reiterates what we heard in the last statement and also reflected in the last minute. She says, if the economy evolves as we expect, economic conditions likely would make it appropriate at some point this year to raise the federal funds rate target. But again, she hedges here. Let me emphasize again, these are projections based on the anticipated path of the economy, not statements of intent to raise rates at any particular time. And finally, in the summary, she says we continue to anticipate it will be appropriate to raise the target range for the federal funds rate when the committee has seen further improvement in the labor market and is reasonably confident that inflation will move back to its 2% objective over the medium term. So in her remarks, really highlighting both the strengths and the still challenges that remain for the U.S. economy. Also interesting that she does mention the international challenges. Now, along with the testimony, we get something called the Monetary Policy Report that the Fed releases. Within that, the Fed, this is not just Janet Yellen, but the Federal Reserve, talks about liquidity in the fixed income markets, which has been a big topic of discussion among market participants. And she says the Federal Reserve is watching related developments closely. But at this point, a variety of metrics do not suggest a deterioration in day-to-day liquidity. So the Fed not yet seeing hearing alarm bells on the liquidity front, Eric.
Julie, you can't see them, but I know you're curious to know how financial markets are responding to this testimony from Yellen. The balanced view on growth seems to be reflected in equity futures. They're pretty much unchanged since those headlines came out. There's been a slight tick down in the 2-year Treasury note, so the yield rising slightly on the back of the headlines from Janet Yellen. Her prepared testimony, Julie Hyman has it.